Welcome to the Real Estate Podcast with Robert Ikard. Today I'd like to talk to you about interest rates and how it's affecting real estate. Many people either want to get into real estate or they'll ask me how interest rates are affecting the market, and they're no. But so today what I wanted to do is give people sort of an inside scoop on how higher interest rates are affecting the real estate market. So in terms of commercial properties, as well as residential, we're going to talk about both, but I'm going to separate them a little bit right now. In terms of commercial properties, like purchases, refinances, CapEx. We'll just talk about that. So purchases of properties, it's the same dynamic in commercial as it is in residential. In other words, your dollars get you less property, get you less value, or I don't want to say less value, but it gets you a lower. Well, it is less value, a lower purchase price that you can afford with the higher rates. And the same dynamic happens in residential as well, real estate. In other words, if you have X amount of money each month, cash flow to put towards a property, and this isn't even talking about getting the down payment for the property. Let's just talk about to service the debt. This is all we're really talking about today. So you have so much money to throw at that debt. Well, if the debt has a higher rate on it, then the property value you can buy is less. That's the same dynamic as commercial and residential. So with purchases of commercial property, you can afford less property. It doesn't matter who you are. If you're a real estate investment trust, corporation, individual buying commercial property, it doesn't matter what you are. Your dollars mean that they go less far. They don't go as far. And then same with refinances. If you have a higher interest rate, which they're a lot higher now for commercial and residential. So if you're going to refinance a building, why would you refinance a commercial property? Well, maybe to go buy more commercial property. If you have equity built up, that's what a lot of people do, is they'll go refinance their commercial property and then they'll pull money out of it so they can go buy another one if they built up some equity in it. Well, it changes that dynamic too, because if you're going to refinance a property, now you've got a higher interest rate to contend with, and it may affect your calculations as far as whether you even want to do it. Also, if you have a loan on a property and you want to refinance it to go buy another property, you might have a low rate loan right now that's for a good amount of time in a commercial property. And then once you see that, then you see, oh, well, wait a minute, if I go refinance this, I'm going to have to accept the new rate of interest, which is a lot higher. So when you do that, it puts a damper on refinances, which also could lower the amount of purchases as well, because that's why people refinance a lot of the time, or corporations. Commercial property is to purchase more property. So that's also putting a negative pressure on purchases. And then also other reasons you refinance in commercial property is to make capital improvements. That's what CapEx stands for. CapEx, capital expenses, capital expenditures, capital improvements, things like that. Like maybe you want to upgrade some major system in the building. Maybe you want to upgrade the appearance of the building, just any number of things. You may want to make it more energy efficient. All kinds of things you might want to do to invest in the building itself. Again, if rates are higher, it's going to put a slowdown on that, on those type of things, because if you need to get money out of the property through a refinance or maybe even a fresh loan against the property, it also changes all the numbers and all the calculations, because now you're looking at doing whatever capital expenditures you want to do on the commercial property, and now the expenses are way up because the interest rate expense is way up. So it's going to put, it is putting a slowdown on capital expenditures, and which is affecting a lot of things. It's affecting a lot of commerce, a lot of business. The people that do the work on the buildings for the capital expenditures, they're going to see that many commercial properties can now not afford it because of the higher interest rates. So it's pervasive throughout the industry, through vendors and manufacturers of equipment and everything involved when you do a capital expenditure. And so it's putting a negative downward effect on all these things in commercial property. So that's an update on how the higher interest rates are happening or affecting commercial property. Residential property, it's the same thing we talked about earlier. It's as far as purchases, refinances, it's the same issues. Really, in many cases, the purchases are going down dramatically in many places. People are staying put in residential properties. They're not moving. They're not going to trade a 3 or 4% interest rate for a double that, because they want to upgrade to maybe a better home or a better neighborhood. Many people are saying, I'm going to stay put with my 30-year fixed 3.5 or 4.5% interest loan, especially in residential, because those are oftentimes 30-year loans. And if you have them locked in at those much lower rates, it's really making people think twice about moving. That's why a lot of the residential market around the country has frozen up in many ways, because it affects a lot of things. Do you want it'll even affect whether people take another job in another city. Because if the job, or even in your own town, if you want to move closer to a different job, if you run the calculations and you say, well, I may make 10, 20,000 more at this new job, and I could take that, but then I'd have to move, and then you add that in, and then you're going to lose the low interest rates, then you're going to have to maybe go to a double the interest rate situation. So it's really not only holding people into properties, it can be holding people into jobs and in cities and in situations where with lower interest rates, they may have changed their situation, but not in the case now, because there's higher rates, and this is really freezing up much of the residential activity. And so that's happening a lot. And as well as residential refinances. I read an article that refinances are up for this, that, and the other. I don't agree with that article. I think that it's still going to be down, because it's still the same calculations, because it's a higher interest rate. When you have a higher interest rate, it just doesn't make sense that people are going to be refinancing more. There might be some activity going up, because people may say, well, I'm going to stay in this current property or home because I don't really want to move, but I'm going to fix it up. But I think as an overall trend, it puts pressure on all of it. Car loans, everything, any loan you have. So those are some of the realities. What are some of the solutions? Some of the solutions are owner financing. Okay, maybe there's a difficult property to sell, and the seller knows that, and the seller also knows that the rates are really high, and that it's hard to attract buyers to that property. The seller, a corporation or whatever, may say, or a person, individual, they may say, well, we'll offer you seller financing. We'll finance the purchase. We'll just take back a loan or a note on the property with a lien against the property, and then we'll keep a lien on the property, just like a bank would do. They'll put a mortgage on the property or a lien on the property, first lien, so they'll take that and they'll do owner financing, and they'll offer that as a solution, and that may have a couple of advantages, several advantages. It may have the advantage of lower rates, possibly. The seller may say, hey, I'm going to go ahead and owner finance this at a lower rate than a bank will give, just to make it more attractive to a buyer. Another advantage of owner financing is it's for the owner is if the person defaults, you can, or the person or the company defaults on the loan, the risk is pretty low in certain ways if they are a decent operator and they're not going to trash the building. And because if they default, you can get it back. And many of those terms are pretty straightforward on the process of getting it back. It varies by state, but that's what one of the solutions is owner financing, and that's going on, and it can happen in residential too. People can offer owner financing. So in effect, individuals are stepping in to be the bank, and they may see that as an attractive option just to get the property moving and selling. And that's something as a buyer, commercial or residential, you should always ask. You should say, every time, you should say, is there any owner financing option involved? There's no harm in asking. You may be surprised that if it's somebody who's been talking to any amount of people for any length of time, it probably won't be the first time they've been asked that. And some of them may give 100% owner financing, 80%, 50%, 20%. It doesn't matter. It may help the deal move. It may give it the grease it needs to move again, to make the property move, to make the deal happen. Because their owner financing may have more attractive terms than what would be offered by a bank. Or here's the other thing. Banks may not be offering the loans at all right now. Many banks are pulling back. They're stopping lending for commercial properties, and some also for residential, but there's big banks that do that as well, but they're pulling back a lot because they don't know either when this is going to stop. The interest rates have been going up, up, and this is what's hurting banks and the banking industry. If you have a loan out there and the rate has gone up, well, now the value of your loan, which is just a financial product, really, if you think about it, goes down. Every time the rate goes up, the value of your loan goes down. So that's hit the banks hard. That's just not a theoretical thing. It's really happened to banks, and it's really many financial institutions are technically insolvent right now because they are holding so much debt that is on the books. Banks, and this won't be talked about much but banks and other financial entities may enjoy special rules to where they don't even have to put it on their balance sheet. See, as the debt goes down, as the value goes down as a result of the increased interest rates, the value is actually down, but they don't have to put that on their financial statements, and so that's a thing that banks can do in many cases, and it's much more involved than I'm saying right now. But so it's actually worse than it looks for the banks right now because the rates have gone up so much. So that's a whole nother side story. But what's happening is with with this dynamic going on, many commercial banks or banks that do commercial loans are saying, wait a minute, we don't want to keep getting trapped in this situation where we give a loan and then boom, the rates go up again. Now that loan's worth less. And so many of them are buying US government treasuries instead because they feel like it's less risky. There's a lot more risks to a bank in dealing with a real loan and a real borrower and all the realities of that potentially to them than just buying government bonds. But so just the availability of loans is also gone down, not only the expense of them. And another thing that's happened is the banks have increased the amount you have to put down as a down payment for commercial properties. So that makes it harder for people or companies to get into commercial properties because now the down payments are higher. So there's just all kinds of things that are happening in a negative way in real estate right now. But there are solutions. Owner financing can be a solution. That's a good solution, but you got to be careful. Talk to your own lawyer and financial advisor before you either give a loan on those terms or receive a loan on those terms. They can be tricky to set up, and got to be careful what you're doing. But if you protect yourself, both as the buyer and the seller, it can be an avenue to open things up. So that's just a little update on how interest rates have affected residential and commercial properties in the real estate market. Thank you.